Hello, welcome to the 82nd episode of What the Wealth. I'm your host, Jonathan Bednar, certified financial planner and co-owner of Paradigm Wealth Partners in Knoxville, Tennessee. Today we're going to talk about some questions we're getting with clients around, what do we think happens next? And what they're really talking about is the back half of the year. And there's a lot of questions and concerns about where the market's been really going on the last 18 months. We hit all-time highs in December of 2021. 2022 was a really brutal year as the Fed raised rates really aggressively to fight inflation. And so we had a pretty dramatic sell-off. I think the S&P hit down 25% at one point. And so it's just been a really, really hard grind down for the market, for investors and client accounts. And so we're getting this question frequently around, what do you think's kind of coming down the pike, and how should we plan for that? So I want to take a few minutes to discuss kind of what we see coming here kind of in the short to intermediate term, maybe throughout the rest of the year. And who knows if this is even right. I'm not really trying to make predictions here. I think these are just things to think about that, it's kind of keeping the market on edge. So first thing I want to talk about is, sorry, I'm adjusting this camera if you're watching it on YouTube. Inflation is still continuing to come down, and some of that is from the numbers from the way they measure inflation is by rolling 12 months. So when we get a new month's inflation report, the 13th month falls off. And so it's like inflation is really red on kind of this rolling 12-month period. And so we're getting to the point now where inflation from late spring and summer is going to start rolling off. And as those months roll off, we should see inflation continue to come down. So that's a good thing. That's really a positive for the market and for the economy, for our spending, and really should probably put us in a position for the Fed to pause their rate hikes. I think that's my consensus. I don't think they really probably should have raised this last time. I think they should let some of this play out. But they're being steadfast in those decisions to raise rates. So that's kind of where we are on the inflation front. We did get some news most recently again that I think the inflation hit 4.9 is what it was. So that's a positive. Looking forward, there's a couple of other things that continue to kind of weigh on the market and investors' minds and psyches. The first of them is still kind of the inflation number, and the Federal Reserve is being steadfast in some of their language. While I do think they pause, they're being steadfast in some of their language that if it warrants, they will continue to raise rates. And so the market's a little on edge with that, not much. I think some of that's kind of factored in and to be expected. The other thing to think about is the looming debt ceiling. So, we're on a kind of a time crunch where, we're going up against what the Congress has given authority for us to use to finance and fund our country. And so we're coming up against that debt ceiling, and there's really some hardline posturing on both sides about, not wanting to make any exceptions, and then the other side wanting, some pretty strict cuts. And what's that going to do? Ultimately, I think this gets resolved pretty easily. I think they'll obviously wait till the 11th hour, and it'll take place in witching hour. But I do think something gets done, and I'll tell you a couple reasons why. The debt ceiling has been raised around 78 times since 1960. So this is not the first time we've had this experience. It certainly probably won't be the last. As we continue to run with a not balanced budget, and we continue to spend more money than we take in, we're going to continue to have kind of these debt ceiling conversations. And so that's one of the things that, right now we're really dealing with, is that debt ceiling. So they've raised the debt ceiling 78 times since 1960. That tells me right there that no one wants to risk a default. If we default, now you start to have bigger problems on our integrity as a country and our ability to pay our debts, and then that's going to cause much bigger ripple effects throughout the world. And I just don't think the people in Washington want to run that risk. So I do think it gets resolved. I think it just may take a little bit longer and kind of get caught up in the headlines. So that's one of the things that I think will cause the market to continue to fluctuate and have some volatility. Another one is the banking crisis we're seeing. We've obviously seen Silicon Valley Bank fail, Signature Bank fail. We've recently seen First Republic fail. And so there's some ongoing concerns about some other banks, PacWest, Zion, there's a couple of other, Western Alliance. Those are continuing to kind of weigh in on the market. I remember seeing some news this past week that PacWest had 10% of their assets leave over the week, and that's not assets, 10% of their deposits, and that's a big move for a bank. And so as rates have gone up, it's put a lot of pressure on banks. It's put a lot of pressure on their loans, their capacity, their solvency, and that is still lingering. I think a lot of people are kind of on pins and needles around, do we see another one fall? And if so, what's the magnitude? First Republic and Silicon Valley Bank were pretty big banks, and so they're catching a lot of news. It's not uncommon to see banks fail. It's common to see 4, 5, 6 banks fail per year. You normally don't see the size of banks fail that you've seen Silicon Valley Bank and First Republic Bank. Obviously, we saw a couple like that in the 2008 financial crisis. We saw Wachovia fail at that time. So they can fail. I think everyone's just kind of wondering now, how severe does this get? How far does this spread? And what happens? The irony here is that during the 2008 financial crisis, everyone was worried about too big to fail. The big banks being too big and too much economic power being controlled by just a few banks, and that being bad. And so, the idea was we needed more smaller banks, more community banks, more regional banks to help take some of the pressure off these larger banks. And right now we're actually seeing kind of the opposite. The concern is all in the regional banks, and the commercial real estate that some of these banks have on their books in the form of loans to people. And if they fail, what the impact of that's going to be in a broader spectrum. So the kind of ironic thing is here, now we're seeing these bigger banks benefit from some of these smaller banks fail, and people are taking their money out of these regional community banks and putting them in the larger banks. And it's really kind of a 180 degree flip, kind of ironic here, just fly on the wall thinking about some of this stuff. So we've talked about continued regional banks. We've talked about the debt limit, the debt ceiling. We've talked about federal interest rates, and then there's some talk about a recession the back half of the year. Certainly from a market standpoint, the market performance, it certainly feels like we've had a recession, because just the drawdown we've seen, the time that it's taken. I saw a stat the other day that this is, the longest drawdown we've seen without hitting a new market high, and I think it was 339 days. That's the longest we've seen since the great, financial crisis in 2008-9 time frame. So this is kind of drawing out. The last 10 years we've gotten used to a big drop and then kind of a quick, sharp rebound back up. They call it a V-shaped recovery, but where the market recovers really quickly, and we're not seeing that. It's dragging out. We are in month 17 right now. If we count 12 months last year, the first 5 this month, we're in month 17 right now, and this is dragging out, and it's kind of causing some anxiety, and that's normal. It's uncomfortable, but it's normal. And it's kind of healthy, as painful as it is. It's healthy to kind of go through some of these times and kind of flush out some of this inflation and euphoria that we've had in the market. So those are some things. Again, talk about a recession, concern about how deep is the recession? How severe is the recession? Is it going to be 2008 all over again, or 2001, and tech bubble burst all over again? I personally don't think it does. Certainly this is not my crystal ball projection. This is just me kind of talking around what I think is going on. A lot of times recessions, you're in a recession well before the recession is actually announced. Like, hey, we're in a recession. It's usually the recession's already there, and then usually actually the recession's announced as you kind of start to come out of the recession. So it wouldn't surprise me if we kind of get official word that there's a recession the back half of this year. If we do, my guess is it's probably a mild recession. It's probably not severe, and it probably doesn't last too terribly long. But if you think about that, maybe not lasting too terribly long, if we're already 18 months, 15, 17, 18 months into this thing, another 6, 8, 9 months, which wouldn't be a long recession if that's what it ends up technically being, well, then it's going to spread out over 2 years, and that is a long time, if we count kind of market performance and the pull down in the market. So those are just things that are going on. I think, if you're an investor, and if you're patient, and if you are buying in, if you're younger and you're buying into this market, this is an advantage for you. This is where you're able to step in, and you're able to turn this into positive outcomes. You're able to really make this beneficial for you for your long term. If you're older, and if you're younger too, and if you have some more runway, consider turning your dividend reinvestments on. Let the dividends that are being paid out by, some of your investments, buy more shares, and let those dividends continue to work for you instead of, just paying to cash and sitting there on the sidelines. Use them as a way to kind of dollar cost average and bring your share price down. Buy more shares so that over the long run, you've got more shares to grow as we come out of this and the market, resumes. So that's some of my thoughts, kind of just economically where we are. I think if you actually look at the data, we're from a market performance standpoint, kind of some of the underlying things, companies raising dividends, buybacks, earnings, some of those things look actually really, really good. And so it'll be interesting how some of this plays out. But those are the kind of the key things that we're watching and clients are questioning. And that again is, do we have a recession? Does the Federal Reserve, not the Federal Reserve, but does Congress raise the debt ceiling? And what continues to happen with these banks? And so those are, again, things that we're watching here at Paradigm Wealth Partners, and we're kind of keeping an eye out for our clients. So if you have questions about your portfolio, about your investments, how they work for you, if you have the right plan, we'd love to help you. If you haven't already followed us on YouTube, you can do so at Paradigm Wealth Partners or What the Wealth. And then secondly, if you haven't subscribed to the podcast, then subscribe if you don't mind. Or if you want to make sure you follow along and be alerted of new episodes. So thank you all for listening. We'll catch you on the next episode. Have a wonderful weekend. Be confident in your retirement.